Hello, good day. This is Abiola for Accounts and Business Made Easy channel. Today we'll be looking at standard costing. What is this about? It is costing that sets level of costs and revenues that ought to be achievable when reasonable levels of performance are attained, together with efficient working practices to manufacture product. Standard price is the total standard costs of all the factors of production that make up a finished unit of production. A budget is a financial plan prepared in advance of a definite period of time, like a future financial plan. The types of standard cost that we have are basic standard cost, ideal standard, and attainable standard hours. Attainable standard hours is often used in the recent day businesses because it considers the level of resources put in with what is achievable with those resources put in. What is variance? A variance is the actual result compared with the flexed or budgeted result. The difference between this is variance. So when there is a difference between two sets of figures, the planned and the actual, the difference is said to be variance. The management needs to analyze variance to identify cause of the difference between the two sets of figures, that's the budgeted and the actual. Once the causes have been identified, then the corrective action can be taken as necessary. That means variance analysis is necessary for control and corrective actions by the management. Now, the types of variance that we have are material variance, and labor variance. Then we have overhead variance and sales variance. Starting with material variance has two sub-variances. That's material usage variance, a sub-variance, and material price sub-variance. To have a rundown of how this is done, S can mean or we denote standard figure as S, quantity as Q, price as P, A as actual figure. So SQ is standard quantity, SP is standard price of the material, AQ is actual quantity of material used, AP is actual price of material used. So materials usage variance is SQ times SP minus AQ times SP. SQ times SP minus AQ times SP. That means SQ times SP, we do that, then we subtract AQ times SP from it. The difference here shows us the difference as a result of budgeted usage and the actual usage, since the standard price remains the same on both lines. It means that we consider just the quantity used, the difference between the quantity used, actual quantity used, and standard quantity budgeted. Then we look for that difference, then we multiply it by standard price. This will give us standard material usage variance. The second material subvariance is material price variance. This shows the price that varies from what we budgeted and what we actually spent. That's actual quantity multiplied by standard price minus actual quantity multiplied by actual price. The difference between these two totals must be due to differences in the budgeted price, as the actual quantities remain the same. An example here, RG Baggy provides the following information for raw materials. Materials used, budgeted materials 2000 kilogram, actual 2100 kilogram. Materials cost per kilogram, $8 budgeted and $8 actual. So calculate the direct material usage subvariance. So if we go back, the formula for materials usage is SQ times SP. We deduct AQ times SP from it. So if we do this, it shows that the quantity of difference is 100. Sorry, 2100 minus 2000. That gives us 100. 100 times the price, that's 800. Now, if we look at it, materials used is 100 kilograms more than budgeted. Since it is more, it is adverse. So 100 kilograms excess used multiplied by 8 per kilogram, that's 800 adverse rather, caused by using more materials than were budgeted for. The second example here is to prepare price subvariance, materials price subvariance. Here we look at the variation in the price. If we go back to the formula again, the formula for materials price subvariance is AQ times SP minus AQ times AP. So if we look at it, AQ is the same for the two. So standard price and actual price are the differences. So we are looking at the difference in the price incurred. So if we look at it, 1,200 liters were budgeted for and were actually used. But the cost per liter budgeted was $9.6, actual was $9.8. That means that $0.2 was spent more than budgeted for. And or in this case, the answer will be 0.2 times 1,200. 0.2 times 1,200, that will give us 240 adverse caused by an increase in the cost of the material used. The next is direct labor variances, and we have two subvariances. Direct labor variances is just the difference in employees that worked in the production process. So it is subdivided into direct labor efficiency and rate, direct labor rate, direct labor efficiency and direct labor rate variances. So here again, as we did in for materials variance, labor efficiency variance, subvariance is SQ multiplied by SP minus AQ multiplied by SP. SQ is standard number of hours worked. Standard SP is standard wage rate. AQ is actual number of hours worked. SP here is standard. SP is standard wage rate. Standard wage rate. So this multiplied by this minus this multiplied by this will give us direct labor efficiency subvariance. Then to get direct uh, labor rate variance, it will be AQ multiplied by SP minus AQ multiplied by AP. So AQ times SP, we get the answer. AQ times AP, we get the answer. So this minus this will give us labor labor rate subvariance. Let's look at one example. Catap Limited provides the following information for the month of November. Direct labor 37 hours budgeted, 39 hours actual. Then direct labor wage rate per hour $7 budgeted, $7.2 actual. Calculate the direct labor efficiency subvariance. Labor efficiency subvariance is SQ times SP minus AQ times SP. SQ is standard hours worked. SP is standard wage rate. So standard hours work is 37 hours. Standard wage rate is 7 hours. So that gives us $259,000. Then AQ is actual hours worked. Actual hours is $39, 39,000 hours. Then multiplied by SP, which is 7. So that gives us $273,000. So $259,000 minus $273,000 give us $14. Now, is the $14 adverse or very or favorable? If you look at it critically, 259 was okay. Let's look at it from here to make it easier. 39 hours was budgeted. 30 sorry, 37,000 hours was budgeted to use, but 39,000 hours was used. That's 2,000 extra hours was used. So that means basically you can just say 2,000 times 7 was each hour will cost $7. So 2,000 extra hours worked times 7 is 14,000 adverse. Adverse. Now, to get direct labor wage rate variance. So it will be AQ times SP. We get the answer. That's 273,000 minus AQ times AP. That's 800,000 dollars. Now, if you look at this is just looking at the wage rate difference. Now, budgeted, okay, actual hours worked was 39,000 hours, but it was assumed, so it was budgeted for $7. 39 actual worked should have been $7, but instead $7.2. That means $0.2 was incurred as excess. $0.2 was incurred as excess on each hour of 39,000 hours. So 39,000 hours times 0.2 will give us 6,200, or we can do this formula: AQ times SP minus AQ times AP. We will get 6,200. But the 6,200, if we look at it critically, is it adverse or favorable? Actual hours of 39,000 was supposed to spend $7 on each hour, but instead $7.2 on each hour. So zero point 0.2 was excess. That is favorable. Sorry, that is an adverse variance. We spent more than budgeted. So both subvariances were adverse. Thank you very much. On this, we'll stop the standard costing. Next class, we'll continue on overhead costing and sales or revenue costing. Thank you very much.